Dangers of finance companies. Where you have complexity, by nature you can have fraud and mistakes. This will always be true of financial companies, including ones run by governments. If you want accurate numbers from financial companies, you're in the wrong world. How complex are financial companies? Charlie says that it is almost impossible to know if one has gone astray until the day a company collapses. Just look at Lehman Brothers. 1 year it is trading at $65 a share and is the toast of Wall Street. A year later it is in bankruptcy. The same for the insurance giant AIG and the great investment banking house Merrill Lynch. 1 year they are considered two of the soundest financial arms in the world. The next year they are begging for money from the government. What makes financial companies so complex? Derivatives make it possible to hide risk from the prying eyes of regulators and investment analysts. With AIG it was impossible to see all the credit default swaps it had written on subprime mortgages, because it never set aside any reserves to cover its losses. That meant the company's risk exposure was hidden from the investing public. You could have read Lehman Brothers' annual report 100 times and never realize that it was borrowing hundreds of billions of dollars short-term and lending them out long-term to non-subprime mortgages that they then used as collateral to borrow even more money. A commercial bank might be using derivatives to take a massively speculative position in the currency markets. But accounting regulations are such that the position would be impossible to ascertain until the company loses several $100 million, and we read about it in the financial press. Charlie's rule for financial arms is really simple. What looks good on the outside may be seriously rotten on the inside.